So we shouldn't take much comfort from the yields coming down around the world because they're coming down on growth concerns. The European PMI numbers were horrible. Germany is at 44. And in China, while the GDP numbers beat, there's a lot of question marks about it, especially given what's happening in retail sales. I think what's happening to our market, and it's wonderful to have the best week since June, it's wonderful to see the rally continue, is that we've redefined what a pivot is. We've redefined it from meaning lower rates to pausing to slowing. And if you redefine that, then you will have a liquidity effect. And that's what we're getting. We're getting a liquidity effect rather than a fundamental effect. There is significant value in certain parts of the market. So yes, if you just need a catalyst. The one thing I would caution, you heard from Roger Ferguson earlier today, that this is not because of inflation. Inflation hasn't turned around. Core CPI continues to go up. This is because of financial stability. There's concern that this front loading of rate hikes, and it's massively front loaded, will break something in the financial system. So if the Fed does slow, it is because we have financial stability concerns.
That's really bad.
Well, it depends. I mean, if they stop it from getting worse, and if this doesn't harm us and makes us end up in stagflation, it would be good. All I want to say is this is a trilemma. It's not just growth versus inflation. It's growth, inflation, and financial stability. And somehow the Fed has to find its way through this, as does the ECB, as does the Bank of England.
I like that trilemma.
So the UK is a better story. After the market rejected unfunded tax cuts, we probably have a return to more prudent fiscal policy, and the market has priced that in. You see that with the yields, you see that with the currency, and that means the Bank of England doesn't need to be as hawkish. Japan is a different issue. Keep an eye on Japan. It is a potential source of systemic risk. Look, when you fix any price against what's happening in the global economy, in this case it's yield, it's the yield curve control, you have tensions building. And you've shown the currency, there's been massive intervention. The Japanese bond market hasn't functioned properly for weeks. So they're going to have to exit YCC. And the marketplace right now is saying anything that happens in Japan stays in Japan. Let's hope so. But the UK reminded us that cross holdings of assets can create contagion.